Hi everybody, thank you for tuning in to another one of my realty blogs. My name is Paul Blackburn and I'm with Crown Heights Realty here in Chicago, Illinois. The topic I'm going to speak with you about today is the topic of a declining market. And we're going to talk about it from the lender's perspective. As we all know, over the past few years, the market has declined, right? So the term declining market should not be a new concept. However, it is a new concept in the underwriting and the lending industry currently. When you go to get a loan on a piece of property, whether you are buying a condo or you're buying a single family home, you have to get an appraisal on the property. Somebody goes out there, they look at the property, they compare it to what else has sold in the area, and they say this property at this current point in time has a value of X, correct? So they then loan on that amount. So let's say today's value is $200,000. We're going to give you an 80% loan. Therefore, we're going to give you a loan for $160,000. Now, they're coming out with a new concept called a declining market. If your home is in an area where home prices have started to decline over the past couple of months, these lenders, mainly the insurance companies that are insuring the loans for these lenders, we call them PMI companies, private mortgage insurance companies, they are the ones requiring this new declining market study. Basically, they look at the trend of home prices in the area. If they see home prices starting to decline, they will then factor it into the appraisal. So let's say that they see a decline of 7% annually in this market. They are now going to go ahead and do an appraisal on your property and then discount that appraisal by approximately 7%. Now, I'm not sure the exact mathematics behind it. It's definitely a lot more complicated than we see a 7% decline, therefore we're going to discount the appraisal by 7%. It definitely is being done on an actuary level, which is far too complicated for me. But the basic gist of it is that if home prices are starting to decline in the area, then what the banks are going to do is they are going to basically structure the appraisal around this declining market study. Now, on the surface, it sounds kind of like a cool idea, right? The banks are being a little bit more cautious. They want to take less risk. They want to make sure we don't end up back in the same problem that we had a year and a half ago, actually more than a year and a half ago. It's really been 2.5 years since we had the countrywide debacle back in August of 2007. However, I think what the banks are doing in this case is they're really shooting themselves in the foot. The pendulum always swings from one side to the other, and it's definitely happening right here. If you remember back in the heyday, back in '04 and '05 and '06, you can go out there and you could get a loan on a piece of property, basically by doing nothing. When I was 18 years old, I was able to get a loan on a property by simply showing my Social Security number. I had good credit. That was it. I didn't have to provide any income verification. Didn't have to provide proof of funds in the bank. I was basically granted a loan as long as I had 20% to put down. The fact that I did not have a job made no difference. The other thing, too, is people were able to go out there and get loans based kind of on future market value. Appraisers had no problem bumping up the appraisal price of a property so people could get cash back at closing because they knew market conditions were rising 5–10% a month in some cases, that after a month or two the property would be at that price point, and they would have no problem doing that. So it really created a very bizarre market. We had what I would call a hyperinflation of prices in certain markets because people were doing cashback at closing. Appraisers were doing the reverse. They were thinking they were in a highly appreciating market, and they were over-appraising properties. They thought that there was no problem with this property being worth $400,000 when last month it was bought for $350,000. They didn't see that as a problem. And basically what that did is that caused a huge run-up in pricing that got us to the mess that we are in today, among other things. If you've listened to some of my other blogs, you know my thoughts on that. But what the banks are doing now is the exact reverse. They are doing the exact opposite by saying, if the market is going down in price, we are now going to discount the loan even more, therefore making it harder for people to get a loan for the amount that they want, meaning that they are either going to have to go for lower priced properties or they're going to have to put more money down, which in a lot of cases people simply do not have. At the end of the day, cash is finite. There's only a certain amount of money somebody has, and you cannot necessarily ask every first-time home buyer or even second or third-time buyer to come up with more money at closing because they are in a declining market. So I think what's going to happen here is it's going to do the exact opposite. In a lot of these areas that are considered declining markets, this new declining market study is going to basically push prices down. It's going to cause the reverse of what happened before. Not only that, lenders who loaned on properties back in month number one when something was priced, let's say $200,000, are now not going to loan on a property 3 months later that is priced at 190 because now the declining market study is going to say in 6 months it's going to be worth 180. And that's the problem with the market. While it may seem like, okay, it sounds smart that the banks are going to try and hedge some risk here, they're really doing themselves a disservice because they are basically artificially lowering demand. There's a demand for a certain amount of homes in the market right now because there's an X amount of buyers given the current lending standards. What they have just done is they've just tightened demand even more. And the problem with that is we have to soak up inventory. We cannot get the inventory off the books. We cannot lessen supply and have supply and demand equalize if we are constantly squeezing one end of it. We squeeze the supply end recently by stricter lending standards. And now what we're doing is we are squeezing the demand end, well, actually not really squeezing. I mean, we're compressing demand right now by saying that you now have to come up with more money because you're in a declining market. Well, who's to say that we're necessarily in a declining market? Maybe it's just simply the fact that there's a lot of foreclosures in the area, and finally those foreclosures have come offline. And at the end of the day, it's also kind of it's almost a circular logic because in theory, in order for the area to appreciate, we have to have higher demand because we have to have more people being able to get loans. If we are basically saying the market is declining and we're pushing buyers away, we are keeping the market at its current levels. We are not allowing the free market to take effect. And the free market to take effect is what is the price of the current home today. The current home today is priced at maybe 190 because the seller agreed to 190 and the buyer agreed to 190, and that's the value of the property. As long as it's not outrageous and everything else in the area seems to be at about 190, then that's the price today at 190. We should not be looking at the price tomorrow and then loan on it today. That goes against basic economics. We did that in the reverse at the beginning of the bubble, and that's what caused the bubble. And now we're doing it at the end, in the aftermath, in the reverse, thinking we're going to be more secure, and all the banks are doing is basically shooting themselves in the foot. They are being idiots. They're now looking at basic economics. So I challenge everyone out there who is a banker or an actuary who basically have put these ridiculous standards into place to go and take an economics 101 class. And to look at a supply and demand chart, and just to sit back and to think about the basics of supply and demand and what it's going to take to get us out of this recession, get us out of this problem that we're currently having in the real estate market. I'm not asking banks to go out there and to lend on properties that are problem properties. What I'm asking the banks to do is stick to standards that have been used for years and years and years. We got away from those standards during the boom. We have to go back to those standards now. Not only did we go back to those standards, we decided to bypass those standards and then create a whole bunch of new crap that is basically an extreme version of the original standards that we had in place. So I'm basically asking banks to go back and say, you know what, let's look at the value of a piece of property today. If this value appears to be legitimate, we're going to go ahead and we're going to loan on that value. We're not going to look at a declining market. Believe me, the majority of markets in the U.S. have currently declined to the bottom. If they're going to decline a little bit more, so be it. They're not going to decline much more. The only way we're going to see a greater decline of 5, 10, 15% a year is if banks start using this declining method to value properties. So basically that is my 2 cents and I'm sticking to it. If you have any questions, you can always email me at paul@chrchicago.com, or you can visit me on one of my plethora of websites, rentontrump.com, rentonshooterville.com, Chicago Luxury Properties, chrchicago.com, among other things, or you can always just Google my name, Paul Blackburn Chicago, and you'll get all my info. Thanks for watching. Have a great day.